Hello, Smarties, and welcome to another episode of Smart Real Estate with Westcliff, where we help you learn, invest, and manage your real estate investments. Today, we have a special episode where we have Aziz Zahmoul from Centurion Asset Management, who's going to be talking about their fund and all the great things that they have been doing in real estate since 2003. Before we get started, there are four outcomes that we have for you during this presentation. We're going to do an introduction to Westcliff. We're going to be doing an introduction to Aziz. We're going to be doing the investor presentation, and then we're going to point out our next steps and any disclaimers. As always, my name is Addy Saeed, and not joined with me today is my partner, Kaz Jaffer. Both of us are registered dealing rep with Waverly Corporate Finance and Westcliff Corporate Finance. As my background, I'm an accomplished realtor as well as a dealing rep with Waverly. My partner, Kaz, is a CPA CA with an accomplished background, helping a lot of real estate funds and clients across Canada and the USA. Our ethos, learn, invest, manage. We help our clients and our prospects learn about real estate investments. Our webinar here is another example of it, where we're teaching you different ways of investing in real estate. We have our Smart Real Estate podcast. We also have our Westcliff Investors Network, where investors can join and talk to other investors and learn from them, as well as ask questions. Once you've had enough education and you're confident, you can invest with us. We can help you make smart, informed decisions. And all of this can be accomplished by setting up a simple appointment with us by going to cal.westcliffam.com. And if you're a real estate investor that has assets that need active management, feel free to reach out to us. We can help you actively manage your assets through our asset management services. You can find more information about it by going to westcliffam.com. And without further ado, this is Aziz. Aziz, thank you very much for taking the time and joining us. Before we get started, can I get you to just sort of give our listeners a bit of background about you? How did you become the director of investment sales at Centurion? What did you do before? Take it away.
Thank you very much, Addy, for giving me the opportunity to speak to you, to your investor, about Centurion. But as you mentioned, my name is Aziz Zahmoul. I'm the director of sales here at Centurion Asset Management. And I've spent 8 to 10 years of my life in Montreal. I did my study in accounting. I thought I'm going to be an accountant, but then life brought me to a different road where I actually had some kind of love for numbers and finance. And so I started my career at a bank, CIBC, as a mortgage rep. And then I switched to Sun Life, where I actually discovered the institutional investing, where I manage a portfolio of pensions account. And basically my job is to kind of get a deep understanding of the institutional pension at Sun Life. And then obviously Centurion, I was kind of looking for other opportunity. And when I look at real estate, I said, this is something that going to be interesting, and start reading and doing some research. And without further ado, I kind of accepted the offer. And here I am. I now actually was the associate director at Centurion, hired in 2019, 2 years as associate director, and I was promoted about 9 months ago as a director of sales here, where I actually actively manage relationship with advisor like yourself, Addy.
So you're one of 87 staff members there. So your role is mostly working with investors and working with dealing reps that are raising money. Am I correct?
You got exactly. And thank you for bringing that number up, because I think that 387 is one of our competitive advantage. 387, so about 80 of those are head office, and about over 300 are the property management. And the reason why I said one of the competitive advantage, because Centurion, we own and operate our own building. We don't hire third party to manage our own buildings, and that we can talk later about how that can benefit the unit holder.
Now, that's a very, very interesting point, because a lot of the funds that we're seeing, especially in their early stages, they will have a third party manager to manage the property. But you guys, because of your size, are able to hire the property managers in-house and service your properties yourself. What are some of the advantages and disadvantages of something like that? Let's just run through it quickly.
Absolutely. So I'm going to start with a disadvantage, especially for Centurion. When we acquire a brand new building, we want it to be empty. We want to fill it with the body that we think they fit our portfolio. So the disadvantage of that is obviously you need some time to stabilize this portfolio because they're empty. Now, the biggest advantage is when you own and operate your own apartment buildings, one of them is the economy of scale. If you have 3 buildings in the same area, you have the same property management team that can manage 3 different builds. 1, 2, you can reduce the cost and be more efficient to your unit holder, because I'm going to give you an example. We have sensor for all the washroom on over 22,000 unit in the portfolio. So if you have a washroom that's going for a couple of days, then you send the superintendent, that's cut on cost, which translate to performance to the unit holder. So that's kind of the advantages of this type of managing your own rather than hiring a third party where it's all about spreadsheets.
That's good. So your portfolio
Yeah.
is quite vast. What do you want to tell us about your portfolio?
Yeah, so we manage 7.8 billion in asset. We are Canada's largest private apartment REIT, and we basically target apartment buildings in suburban ex-urbans area. Centurion's strategy to never invest in downtown doesn't mean it's bad or anything. It's just that's not a market where we look into. Our portfolio is spent from coast to coast with roughly 1/3 in Western Canada, 1/3 in Ontario, and 1/3 in Eastern Canada, primarily obviously in Quebec. We just try to offer investor exposure to Canada's strongest rental market, and we not concentrated in one market. We like to invest broadly from East Coast to the West Coast and everything in between, as we want to have access to different economy cycles, whether in the Alberta market when the oil is doing well, or when the Quebec market and it's cyclical market. So by investing into the REIT, you have access to over 22,000 unit institutional grade apartment building that are split the whole country, never downtown, suburban ex-urbans area that we think that are supported by strong fundamental like population growth and diversified economy.
Now, I'm looking at these numbers and I have to ask, so you have 158 properties, 22,000 units. That's roughly around 140 units per property. So that's a giant portfolio. Can you tell me a little bit about, like you talked about the location, talk about what your core investment philosophy is. Like why, you have a couple of different offshoots. You do equity, you do debt investments. Can you talk about what's the core investment philosophy for Centurion?
Which is a great question because we have lots of fund out there and each fund have their own strategy. So our philosophy at Centurion is long-term value creation, capital preservation, and predictable income generation through private income producing apartment buildings. Now, we specialize in one, multifamily apartments. That's our core allocation, which is over 80%. We do also have student housing because the REIT always been opportunistic since the beginning. So whenever we see opportunity, we jump on it. Student housing, we have about roughly 10%. We are the second largest student housing holder in Canada outside any government run program. And we also have a small portion in medical offices. Medical offices was a pure opportunity that we were approached by a public REIT during COVID. The portfolio was mismanaged. We buy it at a really good price. Now it's fully operating. It's very small. It's about 2%. At some points, it'll be out of the portfolio. But again, as I mentioned, we always look for opportunity. And lastly, which is in my opinion, the competitive advantage of Centurion is we have about 600 to 700 million into the REIT that invested into mortgages. Now, you probably see here that we do not build. That's a risk we don't want to take at Centurion. So instead of building, what do? We partner with developer. We finance the development. We collect about 8 to 10% coupon. But the comparative advantage in this specific strategy is we have purchase option of those buildings. So when these buildings are completed, the developer, they have to come to us to see if you actually want to buy it before it hits the market. So we can acquire a brand new institutional grade apartment building without having to compete with nobody. And you probably know, Addy, that in real estate, you make money on the buying price. So if you don't have to compete or overpay, then obviously it will benefit the unit holder down the road.
So do you set your price when you're actually going into the JV, or is that something that is set afterwards?
So some of them will be forward sales. So it depends on the JV, it depends on the region, it depends on the portfolio. It varies from one project to another. But obviously we want to set the price, but sometimes it doesn't work that way.
So let's talk a little bit more about this medical offices that you have. It's 1.5%. What can you tell us? Where are they located across the spectrum? Is it geographically focused?
Yeah, they're located throughout the whole Canada. We have in Edmonton and Ontario. So when we acquire building or when we underwrite loans, even for developer, we try to do it broadly throughout the whole Canada for the goal of acquiring these at some point. So the medical office is very interesting opportunity is because, as I mentioned, during COVID, some public REIT, obviously they can raise money because the stock is low. So what they do, they sell some of the underperforming asset. One of them was this portfolio of 10 medical offices building. And we saw an opportunity here. It was 50% occupied, very mismanaged. We bid a price that we thought it's not going to be accepted, but they needed liquidity and we actually acquired those buildings. So now the portfolio is fully occupied, very well managed. We sold 2 last year. Out of the 10, we sold 2, 8 left. Now, between me and you, at some point, the whole medical office will be out of the portfolio because it's not in our thesis. But in the meantime, the REIT is taking advantage of it. The unit holder is taking advantage of it. How? Is when was the last time your doctor moved? They just don't move, doctor.
You just retire.
Yeah. And who pays the doctor? Who pays the doctor is the
Yep.
government. So the asset class, it's good. The portfolio is taking advantage of it. Is it in our thesis? No. But again, we always going to be looking for opportunity like this. But the main thesis always stays apartment buildings and suburbans and ex-urbans throughout the whole can.
So is there any restriction to what this, again, this is a fund, so it's a REIT setup, so it's a MFT. Is there any restriction that this MFT has in things that it can't invest in?
I would say no.
Okay.
No, but we do our own restrictions internally. Condos, we don't touch condos. We don't touch commercial. We don't touch office. And we try to not touch downtown, but we're going to give you an example. We acquired 30 apartment buildings 2 years ago in Quebec, which is just under $1 billion, the acquisition cost. But out of the 29th building, one of them is downtown. What are you going to do? You have to take it. But these are the restrictions that we have in our internal team is stick to apartment, class B apartment, suburban, ex-urban. We tend to buy new builds, but we also have some old ones in our portfolio. So it's diversification is key. Diversification is very important for us when it comes to geography diversification. As you can see, try to be diversified, as well as the asset class itself. Apartment, student housing, mortgages, medical offices. And again, the apartment and the student housing are going to always be there. You're always going to have some addition from medical office. So who knows in the future will have for us.
So talk to us a little bit more about your mortgage and JV investments.
Yeah. So back in the day, we used to have a fund called REOT, the Real Estate Opportunity Trust. And then the asset manager decided, you know what? Instead of having 2 funds, let's merge both together. It's going to save you on taxes, save you on fees. And that strategy is, in my opinion, one of the strategies that set the REIT into the success that it's actually navigating right now. Because as I mentioned, we don't like to build. That's a risk we don't want to take. So we partner with a developer, 8 to 10% coupons, majority of time first position, goes to second position, the lowest. And basically it creates a pipeline of leads ready to go to acquire. 1, 2, it also can serve as a liquidity provider. We will talk later about liquidity, but if something happened and some liquidity ran in the market, instead of underwriting loans, we can use those as a liquidity provider. But the whole main point of the mortgage book is to finance development, have liquidity, and then acquire. Now, we used to acquire between 10 to 15 buildings a year, but you probably know, Addy, the market is really kind of dead lately, nothing really to pencil, but we still raise 500 million a year from investors. Last year we raised 500. So if you're not acquiring, what are you going to do with the money? The last thing you want to do is to buy bad quality product adding to the portfolio. So for us, we can underwrite loans instead of putting the money in a bank account. The money is working, getting 8 to 10% interest. And those specific loan may end up in an acquisition. So the mortgage book, in my opinion, is, that hybrid play that you have where you can set it so many road and they all will benefit the unit holder, whether acquisition, liquidity, or even interest generations.
Oh, good point. So before we go forward, I actually should have asked, so what's the overall return that you're targeting for this fund?
7 to 12%. That's our target. Target return is 7 to 12%. So let me break it down for you. The 7 to 12% is a total return strategy driven by monthly distribution and capital appreciation. Our distribution roughly 4.12% annually. And we try to increase our unit value annually between 3 to 6% to fall between the 7 and 12% target return. Now, since the inception of the fund, which was 2009, we delivered about 12.5%, but that's the target is 7 to 12%. And we just try to provide a positive investment experience to the unit holder. We're not looking for home runs, no volatility. It's just steady return that coming from distribution that paid in each and every month, as well as unit value appreciation, depending on the market and the valuation of the portfolio.
So part of your fund, basically what you have is on mortgages, the small sections of 5% of it is what you have in your mortgage and JV investment, and that's generating 8.5 to 13%. Loans could be 50 to 85% loan to value, 1 to 4 year maturity, and your sizes are starting from 5 million up to 25 million. But this only impacts 5% of your fund. Am I right?
Exactly. Okay. Only 5%, because the goal here is to have apartment REIT. We're not looking, because we get some pushback sometimes from advisors that we don't want it to be more than 10% because we're not looking to invest in an apartment. But for us, we'll never go to those levels, that's for sure. And the goal here is just to have the strategy that feeds you leads to grow your main thesis, which is apartment building throughout the whole country.
And I think the best part about this is your first right of refusal or your first right to purchase, where you can actually add brand new assets that you're finally in tune with. Obviously, it went through the approval process. You know the building, you know the specs that it's built to.
Yes.
Everything is been done right in front of you. And it's an asset that you'd be more than happy to have as part of your portfolio. So it makes sense as an acquisition strategy to invest in these ventures and keep the numbers down to 5%.
Exactly.
Yeah, it's a very, very valid point.
And to add one little thing, adding, and it's good for the developer as well. Like, how much risk we gonna take from the developer when you have someone who's just trying to buy your portfolio right away. And we're providing liquidity to the market, that much needed housing crisis we have, by putting more money into the market, developers, so they can go and build again.
No, great points. Talk to me about this slide that you have. It's portfolio rent to market gap, rent gap. So explain what market rent gap is and why is this significant for Centurion?
Extremely important metrics. Thank you for raising this. So gap to market rent, basically it's a metric that tells you if you get all the rent under contract today, you get into market, how much you can realize. As you can see here, as of Q3 2024, we can realize about annually $40 million. Now, if you do apply that to a very conservative cap rate of 4.5, that's about 800 million of unlocked potential into the REIT. You can't realize that overnight. To realize the gap market is basically you need turnover. You need Addy to leave the unit. We do some renovation. And when we have a new tenant, we get the rent to market. So you always have something, a pool of money that you can pull from to realize and make it obviously more advantageous for the unit holder. 1, 2, that gives you another metric. Give you a metric that Centurion charge about 8% below market, which is very important. Number 1 is obviously the rent is going up, but at some points the rent will kind of slow or soften. We still have 8% can act as a buffer. So that's extremely important when it comes to these type of markets, because when rent is going up, all the REITs will do well, but when the markets kind of stagnate, that's where which we call Canada's largest apartment REIT, that's how we can generate return for the unit holder, by having buffers. So yeah, it's a good metric to have. You have to realize it, and we realize it on a quarterly basis, and we'll have the financials soon, so you have an idea how much we realized in last quarter from this gap to market rent. But yeah, it's a good metric, and it gives you an idea of where the fund is headed and how healthy is the rent versus market.
No, it's interesting that you point this out. So Ontario has rent control, and part of the regulation is that you can't kick anybody out of their unit, even though they might be paying $1,000 and you can rent the unit for $2,500. You also can't increase their rent from $1,000 to $2,500 a month. What other markets has rent controls like this? Is this mostly that you're seeing in Ontario?
So a couple other markets. So in Quebec, they have similar thing, but in Ontario, keep in mind, in Ontario, anything built after 2016 have no rent control. So they actually pushing, because they're putting an incentive for developer to build more. So that's why if you look at the Centurion acquisition last, I would say 3 to 4 years, they're all new builds. to kind of mitigate that. Quebec, they have 5 years. If you buy something new, you have 5 years of no rent control. And BC, it's kind of pretty similar. Alberta, no rent control at all. Now, the portfolio, if you ask me on Centurion perspective, I would say 40% of our portfolio is under rent control, 60% it's not. So we've been navigating this since the beginning of the rent control, and we know how to kind of deal with these type of situation. But the key here is to have new builds added to the portfolio if you would like the fund to keep growing. But again, I mentioned in this slide is, even though without rent control, we try to not overcharge. As you can see here, we charge 8% below the market. So in my opinion, rent control won't help, because it's just gonna make the developer not want to build.
Yeah, it's a debate that is in many circles in the real estate world. So basically, one thing I want to point out, I think the rent control in Ontario is November 2017. Any building that is built after November 2017 is rent control free, not 2016.
17.
Just a minor correction. Let me just go to the next one. So let's talk about your management strategy. So you have target markets that you're looking at, you have target assets that you're looking at, and then you have asset management. Talk to me about target markets. What kind of markets are you targeting? You mentioned smaller towns beside cities. You don't want to be in downtown core, but you want to be outside, but you're also in other smaller cities as well. Talk to me a little bit about that, please.
Yeah, so the strategy is always to acquire apartment buildings in suburban and ex-urban areas, because our thesis think that people are actually moving to this area. Now, we all understand that affording a house is almost impossible, but downtown rent is also very expensive. And COVID, actually with work from home, accelerated a little bit the fact that the people are moving outside of downtown, going to more suburban, because they can pay less and have a bigger place. So that's kind of the strategy, is to go to these suburban and ex-urban. Now, keep in mind, we only target major cities. We don't go to the secondary and tertiary market. We try to stay in the primary, sometimes secondary market, but never tertiary market. Doesn't mean they're bad markets. It's just a risk that we're not willing to take. But you're never going to see us investing in downtown Toronto. You're going to see us in Waterloo. You're never going to see us in downtown Montreal. You're going to see us in Blainville. Never in Vancouver. You're going to be in Richmond. So, as I mentioned, we think that these areas that are supported by strong fundamental, population growth, people are moving there, diversified economy, and just the fact that people can afford a better place with the work from home kind of kicker, we think that the strategy is just to be in those areas.
All right. So, and then you're focusing on multifamily, obviously, and student residences. Do you have any new student residences that you're bringing in your portfolio? Or are these mostly new build? Like, can you talk a little bit more about it? I think we do have a slide where you're talking about some recent acquisitions as well.
Yeah.
Can you tell us, like, anything that you're building into the fund right now is either existing multifamily or new developments that you're actually partially financing or being an equity partner in? Am I right?
That's exactly it. So it's hard to add student housing, because our student housing thesis has to be between 5 to 10 minute walking distance from the university, which makes it a little bit limited when it comes to spaces where to have these ones. Because for us, if you have to take the bus or the train, that's apartment building. It's not a student housing. And the closer you are, obviously, the more premium is the student housing. So we just added one last year at TMU, just downtown Toronto, and it's walking distance to all the restaurants, obviously the transits, and it's in a very desirable area that students actually willing to stay there. And don't forget, because with the student housing, you have about 25 to 30% turnover year over year. So having something that's going to be attractive, with obviously the costs going to be costing the parents, not the student, it's super important to have something very desirable, amenity-wise, fully amenitized, with the gym, the barbecue at the rooftop, the security is extremely important. But the most important thing, as I mentioned at the beginning, is walking distance to the school.
So let's talk a little bit more about the asset management. Obviously, you have property management in-house. What are the things that you guys are doing to enhance the value of your existing assets and maintaining value of any new assets that you're bringing in?
Yeah. So in my opinion, it's extremely important to manage your own property, as we touched a little bit about it at the beginning. But at Centurion, we do own and operate our apartment building, except 2 buildings, because we only have 2 buildings in the United States. those are managed by a third party because it's just hard to hire a team. But having a property management team, basically you can dictate what the direction you want to go with your buildings, efficiency wise. I just figured out last week, I went to the office. Actually, we have a team of 6 analysts that are looking for inefficiency into the REIT. As I mentioned, the washroom option, we also have sensor on all the windows. So if the window is open and the heat is going for a good hour, we get a notification. The analyst will reach out to the superintendent. The superintendent will go and ask the tenant to close or reduce. And think, but if you multiply that by 22,000 units, that's a lot of value add to the unit holder. That's how we kind of we reduce capex, we reduce cost when it comes to these type of investment. Economy scale is extremely important in these, specifically when Centurion acquire building, Addy, is we don't acquire one. If we think that, okay, we're going to target the Waterloo area, we're not acquiring one building. We're going to have 4, 5, 6, 7 buildings, because that's where you can achieve the economy of scale, where you have the same technician, the same plumber, the same cleaning teams that manage 1, 2, 3 buildings instead of having 3 different teams. Because the technician is under the payroll, the plumber is under the payroll. Nobody is third party. Everybody's inside, in-house, into the Centurion. They're full-time employee of Centurion. And that's how you bring value. Because the tenant, they want to see the same people they're managing. You know, you feel like you have connection with the superintendent, with the plumber, they're going to come to your home. So we try to create this positive investment experience or positive tenant experience by just enhancing, whether it's customer services, whether the services that we offer our building. And also in the same time, you have to balance the fact that all these are costs. How can you make it efficient so the actual unit holder will benefit as well?
Great point. All right, so let's talk about growth of rental demand. So obviously market prices rental prices have been shifting up. We've been seeing a lot of inflation in the numbers. What are you seeing in your portfolio, and how can you explain it, and what does it mean for any investor that is investing in this?
And it's exactly what we just talked about, is where people actually, and this is explained perfectly, people are actually moving outside of the core downtown areas to the suburban urban. As you can see, the 2-bedroom in Gatineau, Quebec, 14% year over year, Saskatoon 14%, Regina 6%, for the simple reason that paying less for a bigger place. So obviously these trends cannot continue forever. At some points it will soften. And that's why the gap to market rent, that will kind of play an advantage play for the unit holder, because even though the rent growth will contribute to the net operating income, which contribute to the unit value appreciation, but at some points that will kind of slow down. And when it slows down, we have the gap to market rent. We also have, as I just mentioned, how to get more efficient into the portfolio itself, not just by generating income only with the rent growth. You have to be able to find the solutions to generate unit holder income. And that's why we keep saying that Canada's largest apartment is Centurion. That's our tagline. It's important because size and scale does matter when it comes to these investment. So these spectacular number, that's one of the reason we only touch suburban urbans, because downtown I live downtown Toronto and I see like half of the units are empty here. It's extremely expensive. It's easier for me to go to work, to meet client here. But if I didn't have to meet client downtown, I would be in a suburban urban. I would have like a bigger place and I will have some green spaces around me. But so that's the sense of why these rents are high, because just COVID just made it easy for everybody to move out and work from home.
Yeah. So you mentioned before that you have distribution around 4.12% and your overall targeting is 7 to 12%. How much of that is income and how much is that appreciation of these assets? Because obviously these rent prices going up means that any of the assets that you have, they're generating more net operating income. There's more income coming in, means that based on a cap rate, there is additional value being created for any unit holder. Do you have an idea on what the breakdown is between appreciation and income?
So I can give you the breakdown of the tax qualification of the distribution. So last year, obviously we have to wait the full year. We get audited by KPMG to find out about the tax qualification. But last year was 85% of distribution were return of capital. So that's why it's extremely tax efficient when it comes for the investor looking for tax efficient investing. And basically, we're not going to take a deep dive on taxes here, but because I'm not an expert. But the tax efficiency, it's written in our tax code. It's mainly driven by the depreciation of the building as well as the capital cost allowances. So that's kind of make it 85% return of capital. And the other 15% are a mix of capital gain and interest. And that's mainly because we have that mortgage book that obviously generate interest. On the other hand, obviously it's capital gain whenever you have growth in the unit value.
That's a great answer. An offshoot question. Do you guys invest in any value add opportunities? Because I know you guys are doing development and then you're buying properties at an attractive cap rate. Do you look at properties that are value add as well?
We do, but not the last 2-3 years. We do, and we have some value add in the portfolio. You know, in a high yield environment, value add is a little hard to pencil to make the number work. Plus, you want to have a healthy mix between, because value add is basically, you can't increase rent as much as you want. It's rent control, value add, right? And our portfolio is a very large portfolio. So you will have lots of value adds. The goal is to make it more young vintage portfolio. So that's how you have to have a balance. But I always ask the portfolio manager is like, what's the strategy here for the next couple of years? He said, we are looking toward new build until the yield will go down. We can start looking at the value add. So it's a mix between value add and new build, which is, again, plays in the diversification thesis that we like, is asset class diversified, the geography is diversified, and the product itself that we have are diversified. I would say, honestly, between me and you, Addy, I would say 50-50. I would say 60-40, 60 new for value added, or maybe even 55-45. So it's very close.
Yeah, no, it's a great strategy that you guys are employing where you're buying new, so you're diversifying or shortening the age because you have newer assets coming into your portfolio. Because anybody that works in the multifamily space knows that we had a big boom in the 60s and 70s where there was a lot of housing built in Canada. And those are the main portfolio. Those properties are the main assets. They're owned by a lot of pension funds and big funds like Centurion and other large funds too. And those are the ones that get traded a lot. The cost to replace and build asset today is extremely high. So being able to buy new assets and bringing them in your portfolio has advantages, including like reduced operating costs, better cap rates, no rent control, better income because people are willing to pay more when they move into a newer building. So it's a really, really good thesis. Really, really enjoying what you're saying. While we're talking about this, and I think this is a perfect pivot, let's talk about your property review and investment process. So when you guys are actually looking at a deal, talk to me about how you source your deal, how you underwrite the deal. Let's talk about what your management review looks like, what your due diligence looks like, and then when you get to closing, what does it look like? I'm going to ask you to break it down into two different segments. Let's take a look at a development deal, and let's take a look at a development deal where you're being an equity partner, and then a existing real estate purchase.
Yeah, absolutely. So let me start by saying we have 21 team members between analysts, lawyers, and obviously executives that looking into this process. And because we are Canada's largest apartment, we get approached by so many brokers on a daily basis. Even myself, I get calls, can you connect us, please, this and that we have. So when it comes to deal flow, we get real estate brokers all the time reaching out, developer reaching out, and we have our own contact that where you have deals that they're not in the market. And lastly, obviously, we talked about so many times, but the mortgage book where we actually get deals through the mortgage book. Now, the deal underwriting is extremely, extremely diligent at Centurion, and sometimes I hope they're a little bit more flexible because we pass on so many deals because of little small details. When we look at the market, the Addies, we start by looking at the whole region, and then we narrow it to the whole specific intersection of that street to make sure that the deal actually matches what's going on in the market. One. Two is we have analysts that are actually looking at population trends. We want to find the trends before they actually happen, because when they happen, it's too late. And lastly is as I mentioned, the area, which is the transit is close by. Do we have grocery store? Is this a place where you want to be living? If all these yes, then the deal will go to the management review. management did not even see it as of yet. And this is like months of work because you have people on the actual ground from these analysts looking at the ground and asking people just randomly about the region, about what they like, what they hate about it. So yeah, it's so many steps and it makes it a little harder sometimes. And when we have years where we acquire 10 and 15 buildings, that must have taken lots of hours on the ground to make sure that these deals actually work. Now, once they get to the management, obviously the real due diligence happens, the review of documentation, the permits, the building warranty, the floors, and we've got engineers that looking at the areas, the building and everything, and the closing, obviously the final part where we try to make it so it says between 30 and 60, but the goal of the asset manager is always to close within 30 days. And his point of view, if we went through these so many months of due diligence and review, we should be able to close very quickly. So that's kind of the deal process at Centurion and the investment process in general.
So what kind of loan to value do you guys purchase properties at? Any existing property that you're buying, what sort of loan to value are you looking at?
So debt-wise, we are extremely conservative, Addy, on managing the debt. And I get a lot of advisors asking, hey, tell your asset manager to go a little bit higher on the leverage. So our average loan to value in the portfolio is 47%. 47% for an 8 billion portfolio, that's considered low.
Yes.
So we own a lot of equity, right, into the portfolio. Now, our average liability interest rate is 3.63%. So again, that's low. And what we do is we ladder our mortgages over 10-year period. So no more than 10% of the portfolio comes to due any given year. That's one of the strategies we use to mitigate interest rate hikes like we experienced 2 years ago. And we didn't really get impacted because no more than 10% of our portfolio had to be renewed. And that's a strategy was in place. So when we look at deals, we look at cap rate 5.5. If we're lucky, the asset manager will look at 5.5. He wants to be around the 5 all the time. And our average capitalization rate in the portfolio is 4.5. So that's why it's kind of a little hard to get deal pencil when you have all these layers and structure. But again, for us, it's extremely important to add high quality product instead of just add products because we can acquire so many buildings. We have lots of liquidity. We just don't want to contaminate our high quality portfolio.
No, it makes sense. So any new acquisitions, you're going in with what, 45% loan to value, 55% loan to value?
Yeah. Between 45 and 55.
45 to 55%.
Yeah.
And then obviously you guys are looking at CMHC loans for your product, or are you doing conventional?
99% of the portfolio is CMHC. It's purpose-built apartment and the area we target and the contact, it's 99% of portfolio is CMHC, and we actually try to not make any deal with that CMHC financing.
Makes sense. It's another set of eyes for you to review your numbers. So it's when you have the conventional that are going high loan to value, that's where we run into issues. And you guys are not using any MLI programs or anything like that.
No.
It's just the conventional CMHC. Am I right?
Yeah, exactly. That's exactly it.
That's great. Let's talk about your recent acquisitions. I was going through this list. I have to say, some really, really great numbers over here. Can you tell us a little bit more about these 409 units you guys have currently under acquisition?
Of course. And as you can see, it's a beautiful building. So it smells like condo. It looks like condo, but they're not condo. They're apartment building, fraction of the condo, and fully like you even have the dog wash rooms. You have obviously the cinema, the golf simulator, everything. And so if you look at the first one, the phase 3 Knox Village, that's a 3-phase development. We did number 1 through our mortgage book, and then the second one through the mortgage book, and now we just acquired the third one again through the mortgage book that was closed last year. It's the same developer, and we are thinking of doing 2 more because again, the trends are saying that lots of people moving to that area, which is the Kelowna area, which is beautiful, by the way. I've been there twice. It's a really beautiful city. Our kind of the new focus now, the last, I would say 16 to 18 months is the Nova Scotia, Dartmouth area. That's where we actually kind of switching. We closed one last year and we're going to close one more soon. Now, the challenge here for that specific market is, as well as the New Brunswick market, is the lands, the desirable lands are owned by couple families. So it's really hard to make them to sell it to an investment fund like Centurion, But we're being successful step by step. But you should see more acquisition happening toward that area, as well as the Saskatchewan and Alberta market. So one thing to note is for acquisition, yeah, obviously it's really good, but we used to close between 10 to 15. But as you probably know, the market is really dead lately with interest rate high for so many years. Nobody built anything, as well as we are super bad on construction here in Canada. I'm not even gonna start talking about that. But when like we had some interest rate cut last year, it holds now, but I think we're gonna get back to cut again. But when interest rate cut make its way through the system, it takes time. That will create momentum in the market. Why? Because developers are gonna try to sell whatever they have in the stock to go finance on a lower yield to build more. And that's how we create momentum. And that's how Centurion actually operate, because on the balance sheet, we're extremely liquid. We're just ready for opportunity. And actually the asset manager, Greg Ramon, thinks that there will be a window of opportunity of Q1 of next year that's going to open up. And we just want to be ready for it. And in terms of acquisition is the asset manager thinks that because of the supply demand imbalance and the housing crisis that we're living in, he thinks that we will build more apartment building in the next decade that we built in the last two generation. And having a fund like Centurion where you have the size and scale, I think we will be very active in the upcoming months / years.
That's very interesting. And I agree, because given the programs that are coming out by the government of Canada, including CMHC, I would be very remiss if I say that, we're not going to see any development. But it also creates downward pressure on existing asset owners and their rents. More supply coming in means that rents are going to stabilize, which is a good thing, because I don't know a lot of people that can afford to pay $3,200 a month for a 2-bedroom. Before we move on, I'm curious about these percentage ownership. So you have 100% ownership on your King Knox Village, you have 50% on Westport, you have 75% on High to Be, on Urban Edge. Who are the other partners? Why are they 50 and 75% versus 100?
So the hundreds is our acquisition, pure acquisition. The other one is coming from the mortgage book, where sometimes the developer wants to keep a percentage, but at some point they will be all out of it, because the goal is to have 100% ownership of the portfolio. And in any portfolio at Centurion that goes through at least 2 to 3 years, that are 100%. But sometimes, in a deal, you have to make a deal with the developer and they ask for ownership and you give them the ownership. But at some point, the goal is to get 100% ownership.
Is this very, very common where you are equal shareholders or majority shareholders? Do you ever take a minority shareholder position?
Never minority. Half is I would say the least we go.
Okay. And then what's the benefit to an investment to a unit holder? Is it like access to this property wouldn't be available otherwise? Or is there any other intrinsic benefit that they can recognize?
Is the price that we bought the property at will benefit the unit holder, because if you give ownership, obviously you actually can pick the price you want to choose. And at some points, that ownership will be the ownership of the developer will be diluted with strategy we put in place and contract to acquire the remaining 50%. So it's a strategy we've been using since the creation of the fund. It's been working, and you don't change something when it works.
I agree 110%. Let's talk about this Knox Village, Kelowna, BC. You had a separate slide for it.
So that's the one, yeah.
Yeah, you had a separate slide for it. We wanted to make sure we included. One thing that threw me off is that it's just built in 2023-24, and you're already doing outdoor furniture and glass showers in 2023.
Exactly.
What happened? Why wasn't it done when it was built?
You know what? Because we actually listened to what the tenant will say, and the tenant, the majority of them didn't like it, to be honest with you. So what we did is we just gonna refresh it, because as I mentioned, when specifically in this area, Addy, is you have people, unfortunately, obviously, buying a property is not even a question anymore. They're not even saving for a down payment. So we try to create this positive tenant experience that you call a Centurion apartment home. So when they talk, we try to obviously have to make sense cost-wise and everything, but we want to make sure that it actually gets done. So that's what we're doing. We're doing lobby furniture for phase 1 or 2. Okay. But this specific one that I was talking about that's where we did the phase 1. We are actually getting to phase 4 and maybe 5. Why? Because we have lots of people. 74,000 requests we got last year in our portfolio. 74,000 rental requests. We only have 22,000 units, and only 5%, let's call it, vacant. We've got 74,000, and I would say over 20% is out west between Kelowna, Alberta. And so just tells you that the demand is huge. And as long as we have demand, we're going to keep adding in those specific area. But the thing I want to bring to your attention is we also have a plan for 2028 where we want to do the lobby and corridor refresh. So these are things that we're going to keep the tenant engaged, happy, engaged. They think about it as their own home. And so, before they break something, they kind of think about, okay, this is my place. This is the place. This is the plan. It's only going to go better from here. So that's kind of small thing we try to add, and we can achieve these because of the size and scale of the fund.
Sounds good. So these are your acquisition pipeline that you have right now that you're working on. I'm actually familiar with 133 Erskine. So this is in Uptown, Midtown Toronto, Eglinton and Yonge. I've actually toured this property myself. This is a 24-unit building, 10-story on a corner. And I believe Avis and Young had this one for sale, and we couldn't make the numbers work. I'd love to know what the story behind this is, because it was being marketed. It was 24 condo units, and it was being marketed as a development site. Again, being Midtown, Yonge and Eglinton, really, really hot area. What's the story behind this one?
Honestly, to be honest with you, I will get you more information from the underwriter because they don't really share. They consider that not public information. The cap rate you buy, the property price, and this and that. But I can get you some information, but I honestly have no visibility on the acquisition. Once the acquisition process start happening, I believe like 4 or 5 people on the acquisition team will have access to this information, but I can ask and see. But what do you see here? All these property coming from the mortgage book. These are development deals that we've done with developer. And as you can see, it's all split between the East Coast to the West Coast and everything in between. Because when we do deals, when we underwrite loans, the goal and the back of our head is we want to acquire these buildings. So few got completed this year. We've got two coming in July 2025, 2 in September, and 1 next year. But these are the stuff that's already being built as we speak now. Now, I want to bring to your attention the Treaty Hill Dev, Calgary, Alberta. So we have it in our new presentations, a picture of it. The reason why I bring that to your attention is that's the first ever in Canada. It's ski in, ski out apartment building on the Olympic Hill of the Alberta Olympic Hill. It's obviously in the summer, you can just go hike, but this is a long-term renting, ski in, ski out. Never happened in Canada before. You can go to every town, and it's the amount of demand we're having for that is just crazy. So again, we're just trying to be a little bit more creative when we add portfolio to the buildings, because I keep repeating myself, and we just want to create a positive tenant experience for the goal of we want them to feel at home. So they care about the place like they care about home, because again, that's when we don't have to fix the whole unit when they leave. That's a performance for the unit holder.
Can you tell a little bit more about this shop on Steeles? It's in Markham, obviously, and your ownership is less than 50%. Do you know why?
So that one, it's going to change. We acquired 60% of it. 32 is the initial deal, and then we increased it to 60% right away before it actually closed. But for some legal reason, you have to put the ownership that you actually agreed at the beginning, in my opinion. But that's about 65%. I will send you the new presentation that we have. You'll see it at 65%.
Yeah, for our listeners, this is from September 2024. So these numbers have changed. But I just like to look at these inconsistencies and just point those out.
Of course.
All right. So you have a couple of properties under development.
That's the one.
There's the Trinity Hill that you're talking about. 557 units, multi-purpose rental complex featuring 6-story frame apartment.
That's exactly it. That's the one on the Olympic Hill. And look at the amenities, the golf simulator, the fitness center, the yoga room, IT rooms, like everything. again, it looks like condo, it smells like condo, but it's fraction of the condo and it's an apartment. And it's professionally managed. Everything is basically included. And this one is almost done. The one on the
Yes.
left, the one in Ottawa, the Albert Street. That's I actually went and toured that one. It is a high quality. It looks like a luxury apartment building, but in reality, it's Class B apartment. It's not, because we don't own any luxury apartment, but it does look like it. It's just not. Again, all the amenities and in a very desirable area.
So I hope you're getting the rents for the luxury in a Class B.
You know, it's the average rent in our portfolio is 2,100. So we try not to be very tough when it comes to these type of markets.
So we talked about the student housing before. So this is the one in Toronto by the new Metropolitan University. 332 beds across 1, 2, and 4 bedroom apartments. You got study lounges. So is this fully occupied now?
Fully occupied, and we get 15 to 20% turnover in that one. The reason why I said that, because any other student property tends to be close to 40% turnover, which is normal. But these ones actually, they stay there. They will go for the second year and a third year. They stay in these apartment buildings because it's a very desirable area. And when you go on Yonge Street, you will see it. Now, if you see this picture, next time you're going to pass by, you'll see it because it's actually yellow. And I think it's the newest building in that area. So you actually see it's beautiful, it's huge, it's massive. And again, the premium on all this is crawling to the university, walking distance. And that's where, because the more closer you are, the more premium you can charge when it comes to these type of investment.
All right. So this has been an interesting presentation. So let's just go through and talk about a summary. So the investment solution, it's a MFT that provides qualified investors with a diversified portfolio of income producing multi-residential and student housing. You also have investments that you are able to make into developments, and with Centurion having the first right of refusal or first option of purchasing them. So it has based on its size, one of the newest properties or collection of properties. Your portfolio is probably the youngest out of the big funds that are in Canada. And so run us through. So tell us a little bit more about the benefits for investors. Why would somebody invest in this?
Yeah, and thanks for bringing that up, Addy. So our portfolio is the youngest vintage portfolio in the market now. The average year is 11 years in the portfolio, which is technically, when you see the fund started at 2003, basically, that's pretty solid. So very simple here. What we offer at Centurion is we offer you the size and scale, which is, in my opinion, it does matter, especially in these tough market right now. We offer low leverage. Low leverage, we think, is very important when it comes to real estate, because you're going to go through some market crises. Having a debt that it's manageable will obviously benefit in the long term. So we offer the lowest fee in the market. Our management fee is only 1%. We do charge a performance fee, but that's the norm. But our performance fee is 15% over 7.25 hurdle. So we have to hit 7.25% before we start the performance fee. So we never had a negative calendar year since the inception of the fund. Our target return is 7 to 12%. 7 to 12% is coming from distribution as well as unit value appreciation. And if you're looking for capital preservation, the fund is available for that. As I mentioned, we had a 20 years of track record. If you're looking for tax efficiency, our fund offer tax efficiency investing. And when it comes to whoever is looking to invest in real estate passively, without the headache of it, without the management of it, you can buy a Centurion and have access to over 22,000 unit and high quality institutional grade apartment building from the East Coast to the West Coast. So the goal is to create a positive investment experience with the lowest volatility possible in the market.
So can you describe your ideal client or ideal investor type? So somebody that is looking for retirement, somebody who is looking to invest cash, like what is your ideal investor type?
I would say the ideal, obviously it's a very hard question, but I would say I'm going to link it to timeline. The ideal is if someone is looking for investment to have the benefit of a fund like Centurion, you have to be in the fund for over 3 years. That's the ideal investor, in my opinion. Now, I would say 50% of our investors are in a non-registered account because of the tax efficiency and corporation as well. But the other 50 are looking for growth mandates, because when you put the REIT in a registered account, the mandate will be growth. So I would say the ideal investor is someone who's looking for income, whether to receive it on a monthly basis or to reinvest it, as well as to have access to an asset class that is really hard to access. And I always put this example is you can use your locked in retirement account to buy a piece in the Canadian real estate, where normally the locked money stays there invested. But yeah, it's the ideal will be someone is looking for income through the apartments in Canada.
Minimum investment?
25,000 on the client level, Addy, which means if the client have a 10,000 RSP and a 15,000 TFSA, the trade will be accepted. And if you have a unit holder that would like to add more, then the minimum drops to $5,000. We accept all the products, RSPs, TFSA, LIF, RIF, pensions, so RESPs. Yeah, all the products are accepted.
A bit of a tough question. What are the top 3 risks you see in the current market, and how are you guys planning to overcome those issues?
I would say number one is, I always ask this question, by the way, to the asset manager and the founder of the company. He says government. Government is always number one problem. Why? I'm going to give you a specific example. Last year, in 1 month, we had a close to 35 to 40 million redemption from investors in 1 month. Why? Because the government decided to change the capital gain taxes and investors made pretty good, decent return for the last 6, 7, 8 years, and they wanted to trigger the capital gain taxes. Did that happen? Never happened. It's just some electoral promises. So number one, I would say government. If they come up with something that we don't really, me and you know, it may affect the REIT. Number two is the stock. I would say the stock of, if for somehow we get really good on building and we have plenty of products hit the market, obviously it's gonna affect in the short term, because on the long term, in my opinion, Centurion will perform well in a stable market than in a supply demand imbalance market.
And number 3?
Sorry, the third one is, which is I like to talk about it, because obviously liquidity, because when you're a private investment, the investor or advisor number one question is, how are you managing liquidity? If you have a liquidity run, are you okay to have that paid, or are you going to gate? So I'm going to give you 3 or 4 things that Centurion has put in place when it comes to liquidity. Number one is, obviously, we have a line of credit of 300 million. We're going to increase that. The more the fund increases, the more the line of credit increases. We're trying to get it to 500, but that's not for liquidity, not just for redemption, also serve for opportunity that cannot wait for money rise. One, if that didn't work and the liquidity, it's not enough with the line of credit, then we have the mortgage book. The mortgage book, short-term loans, when they get repaid, instead of underwriting new loans, we can use it as a liquidity provider. If that didn't work, we are very low leverage, 47%. We can always go to the bank and ask for more leverage for the liquidity rent. If these 3 didn't work, we still have a massive inflow between 30 to 40 million on a monthly basis. So yeah, liquidity is always top of mind. And the fact that we manage our debt very conservatively, we have layer, and we got tested twice. As I mentioned, we got tested of the capital gain last year, and we got tested in COVID. We got hit with 70 million in 1 month of redemption. We paid each and every investor, and obviously we publish all the redemptions since the inception of the fund and our offering memorandum. So you can see everything. We're trying to be as transparent as possible. So yeah, liquidity is always a tough conversation. I sleep well at night promoting Centurion because I know we have some layers in place to mitigate these risks.
Oh, that's great. Thank you, Aziz, for taking the time to chat with us. This has been very, very insightful. Is there a question I should have asked that I didn't ask you?
I think you asked me all of them.
Well, I'm glad to hear that. For any of our listeners, if you're interested in learning more about Centurion or want to get any of the information shared here, book a call with us. You can go to cal.westcliffam.com to book a call with us. You can listen to our podcast by going to westcliffam.com/listen. You can join our online community at win.westcliffam.com. You can join us on social media and follow us along. If you want to get copies of these slides, please make sure to send us a text with the word SLIDES slides to 647-799-2264. You can reach us via email info@westcliffam.com or call us at 647-799-2264. Aziz, thank you very much again for taking the time to chat with us. For our listeners, while both of us are professionals, the information shared here may not apply to your unique situation. Always consult with a qualified professional before making any investment decisions. Thank you very much for joining us. And as always, we'll see you on the next episode.